if Bloomberg economics is right, and we get this recession that didn't come in 2023, which I was wrong on. I think we're overdue for. S&P 500 fair value is around 4,000, and that's easy. I think that's a good way to get gold and S&P 500 that fair value back to 1 to 1, which is historically what it was, and gets gold towards 4,000. The thing is, right now, gold's front running that, or is it failing? I think it's front running. And yet the stock market says, no, we're good. We're going to see it keep going up until something stops it. It's the thing that would get it below 3,000. See, let's put it this way. Last year's high in gold was 2,800. And here we are right now at 3,300 and 3,350. So it's doing pretty well. It's already priced in a lot of bad stuff, and it's already got a lot of oomph going for it. So it's an extended bull market.
Gold's breakout performance over both stocks and bonds is emerging as one of the most significant developments in global markets. For long-term gold investors who have waded through years of relative underperformance, recent data now validates their patience. Gold is outperforming equities and fixed income across rolling 3-year periods, a key benchmark closely watched by both institutional and retail investors. This shift marks a significant turning point and is reigniting enthusiasm throughout the precious metals sector. Annualized returns for gold have now surpassed those of traditional asset classes, underscoring a growing preference for tangible stores of value amid rising macroeconomic uncertainty. Bloomberg's MikeMcGlone notes that if equities decline and deflationary forces deepen, evidenced by falling oil prices and continued weakness in China's economy, gold could climb as high as $4,000. However, such an outcome is contingent on a sharp downturn in stock markets. What makes gold's recent performance even more compelling is its resilience. The metal has remained firm throughout its traditionally weak May and June seasonal window, defying the widely known sell-in-May tendency that often weighs on commodity markets during this time of year. Still, the path ahead depends largely on broader market conditions. McGlone points out that if the stock market remains strong and the Federal Reserve continues tightening monetary policy, gold's rally may lose steam or experience a temporary pullback. Major U.S. indices ended last week on a negative note, influenced by rising geopolitical tensions between Iran and Israel. This development could further support gold as a safe haven asset. McGlone adds that if the S&P 500 experiences a correction of 10 to 20% from its prolonged post-2019 bull run, gold could see substantial upside. A price range between $3,000 and $3,500 appears realistic, with a breakout beyond $3,500 likely only if equities turn sharply lower. For now, gold's ability to outperform both stocks and bonds is reshaping market narratives and reinforcing its role as a core holding in times of elevated uncertainty. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I enjoy starting there because my head of agriculture, we had a call this morning. We were talking about corn, soybeans, and wheat. He says, all I see you writing about lately is corn and is gold and Bitcoin. I said, well, because they're going up. At least I have bull markets there. And that's the key thing is I think gold is the most significant bull market really on the planet. And the sustainability is very getting scary, meaning up almost 30% on the year as we speaking on June 3rd is a scary proposition for if it continues because it's the highest ever on a month-end basis versus Bloomberg Commodity Index. It's basically a 100 ratio versus silver. It's never close above 93 on the end of the year basis. It's just expensive versus everything except one key thing, the U.S. stock market, the S&P 500. So that to me is a key driver for gold. Obviously, we know what's the main underlying drivers are. Central banks are buying. The latest I heard from the World Gold Council, who does really good data on this, is Poland has been a lead buyer. Not messing with that. And people. It's all started with Russia's and China's unlimited friendship in 2022. That shifted the world, and it's still building gold. So I think the thing I'm worried about gold now is gold has an issue if the U.S. stock market keeps going up, because I think that's the key thing that really kicked gold in was people are starting to worry about U.S. interest rates going down, the stock, that great wealth creation machine, having a bit of a blip, and it did, but that was it, a bit of a blip. Now looking forward, if stocks end the year up 10%, which is the consensus, gold up 30% might not make a lot of sense, except in an inflationary environment. And the Fed's not going to be easing in that environment, which means it'll be pushing back in inflation. The key thing I'm worried about now that I think gold is predicting is a bit of a pullback, retracement of S&P 500's total return since the end of 2019, which is phenomenal, is pull back 10, 20% of that, which would be nothing in the big picture, but it have deflationary underlays. That to me is what gold's pricing in. So I look at gold stock between 3,000 and 3,500 at the moment, and getting above 3,500 will probably mean U.S. stock market ending the year down. Sometimes, historically, gold is zero correlation to S&P 500. Sometimes it's negative, sometimes it's positive. Now it's acting more like an S&P 500 put. Obviously, without time decay, it's way outperforming S&P 500. So I'm extrapolating into the future what's going to matter for gold this year. What gets it above 3,500 an ounce? It doesn't make a lot of sense to me to stay much above that level with the U.S. stock market strong, the Fed tightening, and the global economy doing fine. It's more of it's to me right now showing that with that gold crude oil ratio breaking out, I mean crude going down and gold going up. That's a bit of a global deflationary event. Makes sense on the back of tariffs. Copper's kind of stuck in the middle. But that's why I'm looking forward to is I just look at the key thing now is what we widely anticipate seldom occurs, according to Benjamin Disraeli, and it's completely anticipated the U.S. stock market is going to be up 10%. So it better be up 10% this year. And I think the risks are it's not. It doesn't. It goes down. And gold, I think, is sniffing that out. The Bloomberg Dollar Spot Index is down 7% this year. Obviously, that's boosting things like gold and copper. And the S&P 500 is up 2%. Typically, they've been on the same trajectory since the bottom of 2009. So Dow weakness is that preempting the weaker stock market? But they have not diverged like that forever. But the one thing that's really diverged is gold going up, in Dow and U.S. stock markets versus the rest of the world going down. I think that's going to continue. It goes to 4,000 if Bloomberg Economics is well. Here's a scenario. Let's play some scenarios. If Bloomberg Economics is right, and we get this recession that didn't come in 2023, which I was wrong on. I think we're overdue for. S&P 500 fair value is around 4,000. And that's easy. I think that's a good way to get gold and S&P 500, that fair value back to 1-to-1, which is historically what it was, and gets gold towards 4,000. The thing is, right now, gold's front running that. Or is it failing? I think it's front running. And yet the stock market says, no, we're good. We're going to keep going up until something stops it. It's the thing that would get it below 3,000. See, let's put it this way. Last year's high in gold was 2,800. And here we are right now at 3,300, 3,350. So it's doing pretty well. It's already priced in a lot of bad stuff, and it's already got a lot of oomph going for it. So it's an extended bull market. To get it back below 3,000, I think would mean U.S. stock market has to keep going. It has to have investors in the U.S. say, those ones who have really started dumping into gold ETFs for 4 years. We've had outflows this year, significant inflows, about 6%. I think that's about 5 million ounces. They've shifted into gold. Obviously, they're buying Bitcoin too. But for get them to start giving up on gold means that they have to have that alternative that there's, when beta goes up, everybody's got involved, and that's still the case. And that to me is why that's the optionality, the risk here right now is you can buy into this and maybe get that 10% that people are expecting in the stock market. Or the big trade is if stock market goes down this year and those deflationary forces you've seen in China and crude oil accelerate downward.
When you say the $4,000 price target on gold, are you looking at this year?
Oh yeah. Well, there's a key catalyst. I mean, key if statement there is if the U.S. stock market goes down, starts trickling lower. It's kind of a prerequisite now because it's just the way it usually trades, and it's trading that way, and it's a bit of a put. Gold's a bit of a put in the stock market, but if it's stock market stays strong, Fed's not going to ease. It's less likely they're going to ease. And there's just less demand for the rock to keep beating the stocks. I mean, there's been good demand when we had that first quarter issue and with, what's happening with U.S. debt and our new president. But if stocks stay stalwart, it's less reason to be buying the rock.
President Trump told reporters this week that he plans to send letters to key U.S. trading partners within the next 1 to 2 weeks, outlining unilateral tariff terms. At a certain point, we're just going to send letters out, Trump said during remarks at the Kennedy Center in Washington. And I think you understand that, saying this is the deal, you can take it or leave it. This declaration adds fresh uncertainty to an already tense global trade environment. Following a political resurgence, Trump is emboldened and appears determined to reshape trade relationships with a hardline approach. Bloomberg's MikeMcGlone highlights that the Trump administration, led by what he calls a business shark, is deploying tariffs as strategic economic weapons, aiming to secure better deals for the U.S. while testing the resilience of global markets. The backdrop to these developments is the temporary suspension of Trump's most severe tariffs, which is set to expire on July 9th. While that pause initially provided a degree of relief to markets, Trump's latest comments have reignited speculation and volatility around what the next phase of his trade policy will entail. According to Yahoo Finance's Ben Werschel, a White House official clarified that Trump's statement about a 55% tariff on Chinese goods is not a new measure, but rather a cumulative figure that includes various pre-existing duties. McGlone notes that the trajectory of future tariff decisions may closely follow stock market movements. If markets weaken significantly, there may be political and economic pressure to delay or soften tariffs. Conversely, strong equity performance could embolden the administration to move forward with additional trade barriers, potentially raising tariffs to 15% or more. Let's get back to the interview.
So now it's really sort of the shorter end. So right now we have Japanese JGBs at 1.5%. I remember trading them. They were 3% and going downward. The significance is they're finally coming out of that deflation. But I like to tilt over to what happens with Japan, to me, is signaling what's happening in China. We're all turning Japanese, and China's doing it right now. Chinese government bonds right now 1.7% versus Japan at 1.5%. It's just catching up. China is the most significant economy in the planet that's going into a severe deflationary recession. It's really normal for a rapidly advancing emerging market that grew too fast, has no autocratic, no natural check and balance like we do in the West. And it's just a massive machine for exporting deflation. And the rest of the world's not even pushed back in them. So to me, that's the key thing to think about with bond yields. Japan has come out of that. It took them 30 years. I traded JGBs in the 90s, and everybody I remember I was doing hedging and trading. Everybody I spoke to wanted to get short them because they thought yields going up, and they were wrong. I think that's where China's going. The significance is, look what's happening is the U.S. How much longer can U.S. yields stay this much high versus the significant exporters on the planet, China, Japan, and Germany? The average yields are around 2%, 10-year notes. So to me, that's the risk. If copper drops, it signals the U.S. yields are going to go that way. Key thing for that is the stock market to go down. And what prevents all this from happening? The U.S. stock market has to stay lofty. So I see what you're seeing there by mentioning bond yields. I have to mention government bond yields in China and Japan. The rest of the world is showing from bond yields deflationary forces. And the key thing that's holding that back from a global recession, which is facing U.S. tariffs now, is the U.S. stock market has to stay up. And that's why I think risks are down. That's why I'm worried about Bitcoin and copper, because if they kick down, that's a flood. That's a complete deflationary domino, which to me is normal. And that's it's not my view. Historically, is normal after you get big inflationary pumps, which we did. Well, I have to push back here a little bit there. First of all, that's one thing I've said, love him or hate him. This man is one of the most significant business clever sharks on the planet. And he's hired some of the best, and they're running our government. Like, if the rest of the world, for certainly President Xi in China, who Zanny Minton Beddoes of the editor economist described as an economic incompetent, you have to have eyes wide open, say, oh boy, what are we doing now? Because this is everything I've read from No Trade is Free by Robert Lighthizer, and by We're at War with Ourselves by General McMaster is happening. And I would say, do not underestimate this human being who's running this government, and particularly what's happened with Doge. So I think our Bloomberg economics expect the average tariff in this country is going to jump up to 15%. We're not there yet, but the only reason he pushed back is because stock market went down. You have to see that correlation there. We are so high, so elevated now. We're close to the end game that everything that's being driven is, if stock market goes down, he'll pull back in tariffs. If it goes up, he'll push more tariffs. It's just the way we are right now. Thank God we're stable. But I would suggest people do not underestimate this person who was in exile for four years, emboldened about tariffs decades ago, and now it's got a second chance. So when I heard that taco, I loved it. But there's one thing about this man, he ain't a chicken. It's just he's not. He's one of the significant business sharks. Love him or hate him, but he's running his government, and you just got to. I had a Middle East colleague ask me about him. I said he's the king. Until he's not, you got to respect what he wants. And I look at simply from a market standpoint, this is what it means for markets. And it would be wonderful if we can get through this period of discombobulation, which he's creating, without the U.S. stock market just reverting a little bit from the 100-year high versus GDP in the rest of the world. That would be wonderful. So far, we're doing it. But you look at the MSCI ex-US index, it's up 17%, and S&P 500 is basically flat.
Crash the market.
It's accomplishing the goal. The point is, what happens with tariffs, just remember why your average CEO based in the US would close a factory, which is completely politically incorrect. And offshore production is for one reason: profits. According to Gina Martin Adams, cost of goods sold in S&P 500 is about 43% from imports. I mean, we're going to crush profits, and we want to see profit margins going lower. So the great wealth creation machine in the US was great. And it's just how much better is it going to get? And the world's getting, they're selling rallies. I think they're going to continue to do that. The point I'm making though is the chicking out thing. I just is completely wrong because this is part of his negotiating tactics. He's getting what he wants. Bottom line, by chickening out, call him a chicken. He'll probably say, "Yeah, great. I got tariffs up to 15%. No one in the entire history of the world has done this in this country except Smoot Hawley. But by the way, the U.S. was a net exporter then." It's just this is phenomenal. We have 100-year events happening, and the stock market's hanging there like wonderfully. And these, but gold's I think figuring out. So to me, that's the thing about Taco and Mr. Trump is. A chicken is not the right word for this human being. An emboldened president who's now leading the free world is probably better, and he's getting what he wants, and at least until midterms. So here's the way I look at it in long term. Either this is going to fail and we get that great recession, which we're way overdue for. I mean, we didn't get it in 2023. We're way overdue for the stock market to create the recession. Same thing that happened in 1929 in the US, 1989 in Japan, this somewhat 1999 in the US. This stock market goes down, creates recession. We're way overdue for that. But if he um, succeeds, what the rest of the world is going to face this for centuries. It's like, sorry, we're done. This is the new mercantilism. And by the way, if you want access to U.S. market, you're going to have to pay for it. Now, that obviously is just the way it is. It's going to be.
Gold's ascent amid shifting economic crosswinds is beginning to redefine how investors weigh risk and reward in uncertain times. As trade tensions rise and policy ambiguity looms, traditional portfolios tied to stocks and bonds are facing renewed scrutiny. Precious metals, which have long been considered secondary to equities, are now gaining credibility as reliable stores of capital. The convergence of geopolitical flare-ups, shifting central bank strategies, and the revival of protectionist trade measures is creating an atmosphere where tangible assets are increasingly favored. If broader market corrections materialize or policy decisions lean toward increased volatility, gold may continue to capture capital flows in search of stability. With market turbulence on the horizon, will investors increasingly turn to metals as the backbone of their defensive strategies, or could a rebound in risk assets disrupt this trend? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.